Roger Montgomery from Montgomery Investment Management, and welcome to this week's Video Insight. February is always a keenly awaited month for observers of the Australian equity market because it features reporting season. In this biannual event, Australian listed corporates release their first half profit numbers for the current financial year. It's usually viewed as an important signpost for equity investors, in large part because it often brings its fair share of surprises, both positive and negative. And it gives some insight into how the economy and companies overall are travelling. About 80% of companies have reported, and they're reporting results that occurred during a period in which GDP for the 3 months to September was softer than expected, with growth likely to remain around 1.5% annually. As is typical during most reporting seasons, it tends to commence with the better companies and the better results. And that we're nearing reporting season's conclusion, the good news is now tailing off, and the proportion of companies beating expectations is doing likewise. Despite the fact that more than a third of companies, about 36%, have exceeded estimates, another 37% have merely met expectations, and 27% have missed. If I was to hazard a guess as to why the market is surprised, it is that there have indeed been positive surprises. No one was expecting that, or very few. In fact, many analysts were bearish going into reporting season. Consensus expectations are for aggregate profits to fall about 5% this financial year. Importantly, however, the decline is largely a function of falls within the energy sector companies on the back of lower oil, coal and gas prices. It's easy to feel despondent, but don't. Plenty of the high quality companies we like to follow and which our managers own have exceeded expectations. Indeed, a majority of the Montgomery Small Companies Fund's top 10 companies have exceeded expectations, and some of them by a lot. Over in the US, Q4's earnings season highlight was Nvidia declaring an AI tipping point, quote unquote, as revenues surged by 265% over last year and by 22% on a sequential quarterly basis. The company's $22.1 billion in revenue for the quarter beat expectations of $20.6 billion by almost 10%, and earnings per share of $4.93 easily beat expectations of $4.64. Now, back on Australian home soil, most of the winners were in cyclicals, but it's worth shouting out those companies such as Lovisa, Megaport and Audinate, all owned by the Montgomery Small Companies Fund, that are growing thanks to an expanding global market. Reporting season admittedly kicked off with the expectation bar set low, and this has helped many companies, particularly those in consumer discretionary, such as JB Hi-Fi, Temple & Webster, Cettire, Lovisa and Super Retail, to surprise to the upside. Price rises that have stuck, combined with cost cutting, have resulted in margin improvements that have also beaten expectations. And this company news adds to the bullish narrative I've been sharing for over a year, that a combination of disinflation and positive economic growth will provide support to innovative growers. Quality, innovative growers are the types of companies all our managers, from Gary and Dom at Montgomery Small Caps, to Sean, Alan and Dan at the Montgomery Fund and Montgomery Private Fund, and Damon and his team at Poland, all focus on. For various reasons, which I'll share in a future video, I believe that while there'll definitely be bumps along the way, equity markets will be a great place to generate returns through to 2026, and this reporting season has been very encouraging indeed. Well, that's all we've got time for today. Look forward to talking with you again soon, and in the meantime, continue to follow us on Facebook and X.